All right, why don't we go ahead and get started? So thank you guys very much for joining. You'll see our little Instagram and, of course, the podcast slide. So anyone who wants to follow us on Instagram, we'd appreciate it. Corporate marketing is going to take away our Instagram. We don't get 300 followers. So we've got, I think, about 140 to go. So anyone who wants to follow us on Instagram, we would appreciate it. But anyway, let's get started. So quick introduction. My name is Mark Lamonic. I look after the individual investor business here in Australia for Morningstar. And today we're going to talk about retirement planning and the transition to retirement. But first, a couple housekeeping items. Number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you are in New Zealand, you can get access to our FAP off of our website, morningstar.com.au. And the New Zealand regulatory authorities encourage you to speak to a financial advisor. So yeah, please do that. So we're also streaming this thing live on Instagram, but Shawnee just sent a note saying Drake has also gone live. So we will see who gets more viewers. I don't know if Drake has hit 300 Instagram followers yet, but yeah, we'll see if we can beat him there. All right, so let's get started. There's a Q&A down here. Ask any questions you want. It makes it more exciting, I think, for everyone. We're going to talk about retirement. So we're also talking about how I can't move the slide. There we go, how to prepare for retirement. So anyone who has any questions, you can email me. That's my name, mark.lamonica1@morningstar.com. Okay, so we're going to take a step back and look at what occurs over people's lives, hopefully. So I came up with this little title a couple minutes ago, as well as this chart or this slide. But yeah, everything you need to know about investing in one chart. So let's go through this quickly, and this will hopefully give us a little bit of a clue to some of the other things that we're going to talk about today and the different insights we want to provide around retirement. All right, so we've got a person. The person starts work at 22 years old. They are going to work for a 43-year career till they are, of course, 65, for those that are mathematically inclined. They're going to save $10,000 a year, and they're going to earn a 7% return over this period. So what we always hear about, of course, is this end number. So they would have a little south of $2.5 million if they do that. But let's look at different stages of people's lives, what the different impacts are during or where they are in different parts of their lives. And I'll try to explain why this is a chart that sums up everything you need to know about investing. Okay, so basically, I took their milestone birthdays at different decades here and looked at what their portfolio value was. So once again, based on the 7% return and $10,000 saved a year, starting from zero, so $0 at 22. So what their portfolio value is. Then once again, they're still saving consistently. They've never raised their savings rate. So they're saving $10,000 a year every year. So what percentage of the portfolio is a contribution every year? And we'll talk about why that's important. Second, I looked at the dollar impact of a 7% return. So that is how much are they getting from their portfolio. So remember, there's two different things, two different inputs that are going into their, in this case, net worth or retirement account or whatever we want to call it. So there's two different inputs are number one, obviously what they're putting in, and then also what they're earning off of their portfolio. So put in that 7% return. And then I took a look at the percentage of time that has elapsed between when they started working and when they want to retire. And then the percentage of this total value that they will have at retirement, this $2.477 million. All right. And we're going to learn throughout this chart about four different things that are really important with investing: compounding, volatility, the time value of money, and sequencing risk. That's a lot for one chart. Okay, so move the chart on. So we still have the top. Now I want to talk a little bit about what you should worry about at different stages of your life, because this will make a lot of sense as we start focusing on that transition to retirement piece. All right, so when you are 30, you have lots of time ahead of you. You have lots of human capital, right? So human capital, of course, refers to the ability of you using your labor or, well, your labor at the end of the day, no matter how you use that, your labor to translate into paychecks. So you have lots of time to make money ahead of you at 30. Financial capital, you have pretty minimal financial capital when you start off, unless, of course, you are born with a bunch of it, which is nice too. But that would be a very short retirement planning webinar if we just focused on being born rich and then keeping that money. So you have minimal financial capital. So what are the implications when you're younger? So the implications are, what is important to you? Well, time. So you need to focus on earning as much money as you can. So obviously investing in your skills and your education. You need to focus on savings. Really, really important. And of course, goal setting, because that can enable you to focus more on savings and understand what the differences are if I could save $11,000 a year instead of $10,000 a year, for example. And very, very important, disregard volatility. So short-term volatility, so basically how much your portfolio is going to bounce around in value, is something that people worry about way too much when they're young. And it's because the investment industry, of course, is focused on that as risk. We've talked about that before. So as you start progressing along, you start slowly transitioning into periods of time where you have less time, less human capital to exploit, but your financial capital should be going up. That's why it's really, really important that we save and invest, because as that human capital goes down, as you run out of time to continue to earn more money, as that happens, we want to replace that with financial capital. So we keep sort of transitioning till we get to the end. And the end, of course, is what we're going to talk about today. We're going to talk about transition to retirement. So the easy thing, obviously, for me to say, and if there's anyone on here who's 22 or younger, save a bunch of money. That's the best thing you can do. Now, why is that so important? Well, if you're 30, this percentage of portfolio is a contribution. So you're putting in close to 10% of your portfolio just in a contribution. What does that mean? That means you should not care at all about volatility, how your portfolio is bouncing around. You got to focus on that savings. The biggest bang for your quote unquote buck is coming from savings. And the fact that you're saving close to 10% of your portfolio value 8 years into this plan, and especially true in the beginning, means that you can wipe out a lot of bad market returns just by continuing to save and continuing to grow your net worth. So once we get out to 60, what do we see here? Well, now this $10,000 contribution is making almost no difference in our portfolio, right? There's a lot of managed funds that charge fees a lot higher than that 10,000 that you're putting in. So the focus shifts as you're making that shift from human capital to financial capital. The focus is shifting on what's going to drive returns and drive increases in your net worth to your investment returns. So just something to keep in mind. The next thing we're going to look at, and we can see this with the dollar impact of the 7% return. So you're still putting in a lot more than you're getting from your portfolio here. But when we get all the way out here, all of a sudden, you're getting 12 times as much from your portfolio if you can make a 7% return than you are from that $10,000 you're putting in. So you see the influence as you age, the influence on your portfolio shifts from time and savings rate to how your portfolio does. And this will have an implication that we'll talk about in a second. And then finally, this last thing, of course, is just compounding, right? So one of the things that I think people struggle with, especially when they're young, trying to invest, and one of the things that, once again, is really going to influence that transition to retirement phase is the way that compounding works. So compounding, of course, is a return on a return. So in the beginning, you're seeing the percentage of time surpassing quite significantly the amount that you have towards your final goal or towards what you will have based on that return. Now, over time, that switches. And that's the power of compounding. So basically what compounding does is over this 43-year career, most of your dollar value returns, which is what we're measuring with this percentage, the dollar value you have, most of that is going to occur in the last few years. And that has a lot of implications for how we have to approach retirement. All right, so that is my everything you need to know in one chart. Okay, we'll get to the questions in a second. All right, so what are you trying to do with retirement? We're going to go through what the implications are of what I was talking about, sort of what happens as your portfolio starts to become more and more important, your savings go down. But what are we going to talk about today? So what are we trying to do? We're trying to, that's Scrooge McDuck over there diving into his big pile of money. So that's what you're trying to amass over your lifetime, enough money to pay for your life. And over here, I Googled like ideal retirement, and that picture came up. So obviously two people surfing. It looks like a Viagra commercial at the end of the day, but that is an ideal retirement in Australia, I believe was the title of the picture. All right, so what are we trying to do? So we've got this portfolio, and we've spent our lifetime, of course, trying to build it up, to save money, to invest money, to make good decisions. And now we, of course, have to shift gears. And this is where a lot of people struggle, is how do I translate that portfolio into something that's going to support your life? And there's kind of 4 different ways you can do this. And I'm sure there's other ways as well, but 4 sprung to mind to me this morning. So obviously income from your portfolio. And we'll talk about why this could be something that's very attractive. That, of course, is you are invested in assets, whatever those assets are. They can be individual shares or funds or ETFs or bonds, where you're probably not getting much, or an investment property that, you know, your portfolio is generating income for you that you can take out of it. The other thing, of course, you can do is you can sell off part of your portfolio. So this is this whole dynamic between income and principal. And we'll talk about why this is important in a second. You can prepay to reduce future expenses. Now, the biggest example of this, and there's smaller examples as well, but the biggest example of this that some people are faced is, okay, should I try to pay off my house completely? And obviously, with housing prices continuing to go up, that probably seems like a little bit like a dream for some younger people right now. But yeah, are there opportunities to pay off your house completely? And what that basically does is it's exchanging money you have. So whether that's money you're earning or you're actually taking money that you've saved and it's in your portfolio and paying off your house, because basically what that's going to do is it's going to wipe out future expenses, of course, mortgage expenses that you have going forward. So that's another decision. So we always focus, I think people are very focused all the time on, okay, what's my withdrawal rate? How much income can I generate from my portfolio? But the other thing you can do is, of course, just reduce your expenses. And living in a house that's fully paid off is a great way to reduce your expenses. And then, of course, we have the option of purchasing future streams of cash flow. So basically, we're talking about annuities here. So instead of me having to worry about my portfolio generating income, the withdrawal rate I'm using, longevity risk, I can, at least for a portion of my portfolio, spend it immediately to guarantee me a future cash flow from an annuity. So basically, and annuities can be complex. There's different types of annuities, but yeah, an annuity at the end of the day is just some sort of guaranteed cash flow that you're getting in the future. All right, so this is the kind of stuff that we are going to talk about today, which hopefully is exciting. All right, and the idea, of course, is to not provide you with rules, but to allow you to think a little bit about what are the different implications at different times of your life and what you're actually trying to protect against. Because investing is full of rules, and people like following rules because it doesn't involve actually thinking about anything. And the problem that people run into, I think often, is that because they don't understand where the rule comes from, what the rule's trying to prevent, and any of the nuance around the rule, because they don't understand any of that, they can very easily just sort of follow a rule off a cliff and not realize the implications of the decisions they are making. So like Thelma and Louise style, off the cliff. Okay, so let's go back to my chart and talk about a couple of the implications here. All right, so we're going to start at this 60. We can say 52, but let's really start at 60, right? As you're starting to think about transitioning to retirement. Now, if you are younger, not a big deal. Start thinking about how you can prepare yourself for when you get to this transition to retirement phase. So what we're talking about here is obviously this hypothetical person is retiring at 65. Yeah, so we're just kind of thinking about, okay, how do we start preparing for that? So a couple of the things that we talked about. Well, two things. Number one, so this savings versus the impact of returns and this sort of compounding effect. So obviously compounding, the fact that we're going to get most of our dollar returns in the last couple of years are a huge percentage. So even when we've only got 12% of our savings time left, we still have over 30% of our of quote unquote dollars to earn to get to where we're supposed to be at 65. So the implications of this are, of course, that returns really matter. And you have limited ability to make up for returns because with the savings that you can still put into the market, it sort of pales in comparison to what you're getting from your portfolio. So it's very different when I'm back here at 30, when I'm putting 10% of my net worth or 10% of my retirement savings every year that I'm contributing that to my portfolio. So I can, number one, it's easy for me to wipe out mistakes. So if I make a mistake, that's okay. I can kind of make up for it. Comes a lot harder at the end, right? So if I invest in something that does really, really poorly when I'm 60, it's very different. It's a very different implication from when I'm 30. So what this basically refers to is something that is referred to as sequencing risk. So it's saying that the order of returns is just as important as the average return. So I've shown sequencing slides. I think there's some in here actually, but the important thing is conceptually to understand that the order of returns is really important, and that if returns are negative and you do poorly when you're transitioning into retirement, it can have huge impacts on your ability to not outlive your money, which you do not want. And so you can see right here, why is that happening? Well, it's happening, of course, because you're going to get so much return based on your portfolio size. Now, the other implication that's really important to think about here is how do people normally combat sequencing risk? Well, they transition their portfolio to less volatile investments. So volatility refers to obviously how prices bounce around or how your portfolio value bounces around. So one way, if I was really worried about sequencing risk, if I was very worried about negative returns right before I retire, well, I could move my whole portfolio to cash. Now, the problem, of course, with that is that as your portfolio, in this case, we're looking at a 7% return over 43 years, as you de-risk your portfolio in terms of volatility, you're of course giving up expected returns. So if I moved my, in this case, $1.7 million portfolio all into cash, what does that mean? Well, particularly right now, it means you're not making any returns, which means you are not getting this compounding effect that you're looking for. So that is the balance that we're trying to strike, is how do we continue to invest in growth assets? And this is only getting to retirement. Like, remember, retirement, you're retiring at 65. I mean, in all likelihood, you are going to live potentially 30 more years, 25 more years. So that's the thing that we're balancing right here. And there's no perfect way to do that. And there is no rule to do that. But there are things that you can do if you understand that risk that can alleviate it. All right, so let's talk about some of these risks and some of these rules. So one rule is the 4% rule. So the 4% rule and this glide path are sort of the two rules we hear about all the time in terms of investing. And the reason for these is because they're trying to combat sequencing risk and longevity risk. So longevity risk is that you don't run out of money before you die. So let's talk first about sequencing risk. So that's this glide path. And basically the idea behind a glide path is naturally as you get older, you are of course going to change your asset allocation and focus more on defensive assets like bonds rather than growth assets like stocks, which is good. The problem is, of course, that you can go too far. And if you go too far, what are you going to do? You're going to miss out on those opportunities for returns as you transition into retirement. So we're going to talk about some creative ways that we can deal with this risk. The other risk, of course, is once you retire. So once you've got that Scrooge McDuck diving into the money bin, and you're hanging out on your surfboard with your partner, looking all happy. How do you make sure that you are smiling and not sitting out on your surfboard, worried about running out of money? Well, the rule that was designed around that is the 4% rule. So the 4% rule, which I know I talk about a lot on here, but maybe we have some new people. 4% rule, of course, is a safe withdrawal rate. It's supposed to be a safe withdrawal rate for how much you can take out of your portfolio and live for 30 years. So remember, there's a 30-year time period on this, all the people that are trying to retire when they're 30. And that 4% withdrawal rate was a rule that came out in the early 90s by a financial planner in the US. So these are the kind of two different ways that people traditionally try to deal with this sort of phase of retirement. But we're going to come up with some different approaches you can take. All right, so let's go through these risks very quickly and the ways you can combat them. So sequencing risks. So once again, it's the order and timing of your investment return. So once again, like we all know how an average works. Average, and back when I was looking at that 7%, that's the average return we're looking at over that 43-year period. But we know there's some years you're going to get 30%, and some years you're going to get negative 30%. And so the sequencing of those returns actually does matter. So what you want is you want the market to, even if you have the same average return over that 43-year period, you want the market to go up significantly when you are transitioning into retirement. And in an ideal world, you would want the market to go down significantly when you were younger, which I think is always interesting because you have all these investors that are just starting out now, which is great. And I sit there and I think the best thing that could possibly happen for you, given where you are on that sort of savings and human capital versus financial capital scale, you don't have much financial capital. It may seem like a lot to you, but over your lifetime, it's not very much. So the best possible thing that could happen would be for the market to plunge in value. So yeah, it's not bad. I actually benefited from this I benefited from this. So, I started investing around 2000 when I was in uni. And if you go and look at S&P 500 returns, so the 500 largest stocks in the US, that 2000 to 2010, the returns were negative. So I probably should have concentrated on making more money and not being such a waste. But yeah, that's actually good, right? When you are saving and investing early in your investing career and early in your regular career, it's great to have a down market. Of course, all of the older people are not happy about that. Okay, so that's sequencing risk. Now, how can you combat it? We talked about lowering volatility in your portfolio. So that's basically that glide path reference I put out there. And sort of the traditional rule that people had was that based on your age, that's how many defensive assets should be in your portfolio. Now, this, of course, was at a very different time. This is when defensive assets like bonds and cash actually gave you some money. You actually earned stuff off of them, not in such a low interest rate environment where we are now. But that was always a rule. Now, I think that rule personally, I think is way too aggressive. So if you turn too aggressive in terms of trying to dampen volatility, that you are putting too much into defensive assets. But that is one approach, right? You lower the volatility in your portfolio, then it doesn't really matter. It still matters. But if the market falls substantially, if you retire into a GFC and half your money is in cash and bonds, well, you're not going to experience quite the negative returns that you normally do. All right. The reason that volatility risk matters, so right, if we sort of get to the second principle of why volatility risk matters is or why sequencing risk and this volatility matters, is because you don't want to sell when the market's down. It's sort of like the old, it's like the biggest rule in investing. You don't want to sell you don't want to have to sell when you don't want to, right? So that's what we do all this stuff, an emergency fund, focusing on the long term. All of that is to make sure we don't have to sell. That's really where you get stung by sequencing risk. So as you start to do your Scrooge McDuck to the surfing thing, as you start taking money out of your portfolio, if you sell in those bear markets when stocks are really low, it's very difficult for you to make up for those returns because, of course, you're selling off principal, which doesn't have an opportunity to recover. So what are some ways that you can actually combat this and make sure you don't have to do this? Well, one way, of course, is to make sure that you have a different source of funds, just like an emergency fund. So almost like an emergency fund. Wow, someone just talked to me. That was weird. Just like an emergency fund for your retirement withdrawal. So we'll talk through that, called the bucket approach. The other thing you can do, of course, is you can live off income generated by your portfolio. So this sort of passive income approach to life is, kind of a dream for a lot of people. And the reason, and there's some pitfalls to this, but the reason why people like this approach is that as long as, if you're investing in stocks or bonds, whatever it is, as long as your dividend payments and your interest payments do not change, as long as your interest payments or your dividend payments don't change, it doesn't really matter what happens to your principal. Like, you don't want to lose it all, obviously, but as it fluctuates, that's just volatility. It doesn't really matter because you're not selling it. Now, the problem, of course, with this, two problems. Number one, you do need a lot of assets to live off the income in your portfolio. So that's the first thing. The second thing, of course, is you need that income to be maintained. So dividends, of course, are not a guarantee. Interest on a bond, is a contractual obligation, but of course, a company or a government could default and not pay you. So the key then is focusing on, number one, having enough assets so that you can generate the income out of your portfolio. And also secondarily, the fact that you want to have stability of income. And unfortunately, what a lot of people do is they reach for yields, which are the least stable. If we're talking from a dividend perspective, the highest dividends are the least stable ones because the market's telling you something by stocks having really high yields. And then you can also manage your fixed versus variable expenses. So what I mean around this is back to that example of paying off your house. Like, let's simplistically say, and somebody's actually writing me this the other day, is talking about sort of the expenses he anticipated having in retirement and saying that, he thinks a lot of them will be variable because he has his house paid off. And so a variable, so if you sit there and put into, very high level buckets that aren't realistic, you've got like your big housing expenses, your mortgage expense, and then you've got travel. Well, what does that mean? It means that at least you have a place to live, right? If you can have, get those fixed expenses as low as possible, things like your house, trying to pay it off so you don't have a mortgage, then everything else is variable. It allows you to make a decision. You may not want to make it, but it allows you to make a decision like, oh, I'm just not going to travel this year, for example. Now, obviously, other people have made that decision for us right now, but that is an opportunity, of course, where you would not have to sell principal in a market condition that you didn't want because you're able to adjust your expenses that way. All right, so this is just an example of sequencing risk. So yeah, kind of same things, $100,000. At the age of 45, you continue to contribute $10,000 a year. And I swear I didn't look at the slide for my other one, just happens to be the same numbers. It's looking at when do these losses occur. One loss occurs at 46. One loss occurs at 64. Same exact average returns, but look at the difference. So investor two that loses his or her money or has that loss at 64 is going to run out of money at 85, while our other investor friend gets to make it into their 90s. So that's just the impact that sequencing risk has. So once again, these are losses that's very difficult to recover from because you're not saving anymore as you transition to retirement and you're selling at low asset levels. So you don't have the same account value that recovers with the market. Okay, longevity risk. So the other risk we're going to talk about, then we can start getting into some of these questions. So longevity risk, of course, refers to the fact that you run out of money before you die. So as I say on these things all the time, the hardest thing about planning for retirement is you don't know when you're going to die. So if there was anything you could do to make retirement planning easy, it would be to get a magic 8-ball or a psychic or somebody that tells you they know when you're going to die. Now, I'm fortunate because I've been told when I'm going to die. Shani told me I would die at 45. So I don't have to plan for retirement at all. So that's very fortunate. But if for most people, they don't know when they're going to die, unlike me. So that's is a lot more difficult. So longevity risk, of course, refers to you've got this portfolio, you need to take money out of this portfolio. How do you do that when you don't know when the end is? And it is obviously sort of the zero sum game of you either run out of money or you don't. So, you don't want to start getting into your 80s and having to start being nice to your kids, hoping that they'll support you after you run out of money. So how do we do this? Number one, obviously, it's a focus on our withdrawal rate. So that 4% rule is supposed to be a safe withdrawal rate. Now, that was using historic data. We've done whole webinars on this, but that's using historic data. Is a very different valuation and interest rate environment that this guy, Bill Bengen, who's the financial planner, was looking at. But either way, 4% rule is supposed to work in any market condition did work in any market condition between 1926 and 1992. So focus on that withdrawal rate. And think about, sequencing of withdrawal rates as well. So people oftentimes, as they progress into retirement, they become less active. They spend less money. So I think that's another problem that we have around a lot of retirement planning is that you read in the press, assume that you're going to spend 70% of what you spend now. Whereas I think in reality, and I'm certainly this way, that when you're not going to work every day, all of a sudden you start spending a lot more money because you're trying to entertain yourself and you have more time on your hands. So yeah, you can have phased withdrawal rates, acknowledging that your spending will probably change in retirement as you get older. Don't get too conservative in asset allocation decisions. So once again, we always talk about retirement as a goal. I'm saving retirement, I'm going to make it by 65. Well, then you have this huge life ahead of you, just given obviously the expanding lives that we're all living with medical advances and just the life expectancy of when you hit 65, how much further you have to do. The other thing, of course, is annuities. So people don't like annuities in general. And they don't like annuities because, and I think I described it this way before, is like everybody has this like premonition that the minute they put down the money for annuities, so remember with an annuity, you're going to take a large lump sum of money and give it to the insurance company that has the annuity in exchange for potentially some annuities, a lifetime of monthly checks from them. Now, the problem, of course, once again, is you don't know when you're going to die. And so people have this fear that they're going to hand over this huge part of their nest egg and then get hit by a bus when they walk out of the street from wherever they've signed up for this annuity. So people don't like annuities because of that. But what they do, of course, is they protect you from longevity risk. And I'm not saying go out there and put all of your money, take your whole portfolio and put it in an annuity, but think about ways to balance that. Think about, once again, your expenses. Is there a portion of your expenses that are fixed, whether that's feeding yourself and housing, all our needs? Is that something that you could cover with an annuity while using the rest of your portfolio to try to generate income, or from the withdrawal rate to celebrate your wants? So sort of wants and needs thing is big, like, I don't know, the barefoot investor says you need like 9 credit cards, which is just exhausting. I have a couple of friends that do this thing and they're like looking, all the credit cards are the same, of course, because they're just different accounts with mostly ING, because that's what he talks about. And they have all these different credit cards with wants and needs and splurge. And it's exhausting. I find budgeting exhausting. But once again, I'm dying at 45, so I don't need to worry about it. Number one, send me an email with any of these questions if you want. mark.lamonica1@morningstar.com. Follow us on Instagram so that corporate marketing does not take away our Instagram account. That would be sad. I'm going to spend 90% of my time from now on creating Instagram posts. And also, so we're doing one of these Thursday at 1 o'clock. We're also doing one Thursday evening at 6 p.m., all Sydney time. So yeah, tune into those. But anyway, thank you guys for joining. Sorry I didn't get to all the questions, but yeah, I'll answer anything you send me an email to. So thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.